Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals, and it's earnings season. So I wanted to talk about using spreads to trade something known as the PEAD strategy after earnings announcements. So lots of strategies might be built to enter before the earnings, but what might a trader do after an earnings? We're talking about a strategy, as I mentioned, known as the PEAD strategy, also known to some traders as the Wall Street Drift. Kind of intriguing name. But before we can get to any of the discussion of what that strategy is and how it might be traded using spreads, let me first of all say hello to everybody who's joining us out there on YouTube. Hello, all you familiar names. Hello, Miralai and Kevin, Greg, Gary, Ricebird, Joseph, Posh, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, though, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording, but be aware that you're invited to join us in the live discussion. This is a Thursday webcast series, and we kick things off every Thursday at 11 Eastern time. We'd love to have you here in our live stream audience. And here to assist our live stream audience, joining me in the webcast today is my very good friend Brent Morris. Brent's going to be hanging out in the chats with our YouTube audience, answering any questions that I can't get to just during the natural flow of the presentation. Brent and I have now been working together for more than 2 decades. I've actually been a coach for more than 20 years, and Brent, I think, outstrips me in that position by like 5 years. So he brings a lot of experience to this. Thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody listening. If you have an account on X, give us a follow on X. You should be following your favorite presenters there. It's the best place to connect with us in between these live streams. You can find Brent on X at Brent Moore CS. You can find me on X at Cameron May CS. But let's get into this discussion. All right. And of course, as we do, regardless of the strategy, there's going to be risks associated with it. So we need to bear this important risk information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so let's lay out an agenda for today's discussion. This video is part of an ongoing series of webcasts, so we already have some example trades in play. What we're going to do is go have a look at our current example trades, see if there's anything that needs to be done with those. Then we'll take a look at what's happening with the markets. Only spend a couple of minutes on that just to set a stage for a discussion about this earnings announcement strategy. Now, how many of you are familiar with the PEAD strategy, or the phenomenon known as the PEAD? Stands for Post Earnings Announcement Drift. Yep, and strategies built around that, sometimes known as the Wall Street Drift. In any case, there seems to be a tendency, according to some studies, that a stock will tend to drift in the direction that is established after earnings, in those days after earnings. So for some traders, they structure trades around that. That's what we're going to be doing today. We're going to be structuring an example spread trade based on the assumption of a post-earnings drift. So as we do that, I'm going to outline some example rules for this sort of a strategy. We're going to put those rules into practice using an example trade. We're going to plan to place that trade today. So should be an interesting discussion. Before we can do that, though, let's go have a look at what's going on with our current positions. So we have 5 current positions right now. I think there's one that needs some particular attention. Another one, maybe. But first of all, we have our Alphabet position. In this, on Alphabet, we purchased a long call, the 180 call that expires in 92 days. We've had it for a while. It's actually treated us pretty well. Bought it for about $25. It's worth about $78. We're up about $53 on that contract right now. At the same time, though, we've sold a short call at $255. The preference here is for the stock to stay below $255. Look where it is right now, $255 and a few pennies. Let's go see what's going on with the chart of this. Here's the whole history of this diagonal spread. We actually bought 2 contracts back here. We closed out one of those for a $50 gain. We have about a $53 unrealized gain on the remaining contract. Now, along the way, we had a profit, a small profit on a short position. We've closed two other shorts for pretty hefty losses. So a $50 gain on one contract, it's been realized, a $53 gain on the remaining contract that's unrealized. Set against that, we've had a couple of $32 losses. Overall, though, trade's going very well. We've been holding on to that long contract as long as the stock continues to run. We had a discussion a couple of weeks ago to maybe keep an eye on this explosive move to the upside. If we pulled back down and broke through that Fibonacci, we had a plan. We might consider getting out, and look how close we got. Came down, touched that fib that acted as a support, which is the reason why we're waiting for a break of that support. The break didn't happen, and we rocketed up, and now we're right up there at that 255 level. This is actually doing just about as well as we could hope. So I'm going to leave that alone. Next up is our JPM trade. This was, if we click on that trade, you can see that this was our trade from last week. Today's the 16th. We placed this trade on the 9th. This was a pure earnings trade. We put on a bear put spread with the hope that the earnings went at least somewhat poorly. Obviously, we don't wish ill toward any publicly traded company, but what's going to happen is what's going to happen. And in this case, JPM, it's seen a little bit of volatility post earnings, but not a really strong surprise enough that would drive it down dramatically. Didn't get that move. So in this case, we did move down, but recovered fairly quickly. And now the stock's moving in the wrong direction. There's no time left on this trade. This is the one I think we need to wrap it up. This is a $5 wide spread. It's losing most of its value. We originally got into this for about $2.25. Right now, it's only worth about 80 cents. Let's try to retrieve what value we can from this. I'm going to right click on this, create a closing order, and buy those, sell this. This is a long spread, of course. We're going to sell that spread, and maybe we can get 80 cents, might be 70 cents. How about if we say we're willing to settle for 75 cents? We're still fairly early in trading right now. The spreads are starting to narrow up for the day. So hopefully we can get a quick fill for this, but I'm going to put in a limit order at 75 cents, saying that's the minimum credit we're going to accept on this on these 10 contracts. Let's click confirm and send. Attempting to sell out of these verticals for at least 75 cents. There is a commission to be paid that will chip into any credit that we're able to retrieve, the value that we're able to retrieve out of this. So we might only be getting out of this for $737 if our order fills. That's the minimum acceptable. But let's send this order off and see if we can get a fill. I think there's a strong chance. We're only asking a 75-cent credit on an 85-cent spread. We'll let that continue to work. I think it'll fill as we continue to talk. But in any case, let's see what's going on with NVIDIA. UNH has actually changed its status since I looked at it this morning. But our UNH trade is a 160, 165 long call spread. In this case, we prefer for the stock to be above 165 as we get close to the expiration, which is one day away. It's Thursday. This thing expires on Friday. We're in maximum theoretical gain position by a pretty fair margin. We're actually up closer to 183. There we are. Sold. We said we wanted 75 cents. We got 87 cents out of that. It's not a great outcome. We bought it for 225. Sold it and collected 87 cents. So yeah, some damage done there. Lost about $1.40 on that trade. Anyway, this one doing very well. NVIDIA. Let's revisit that one. So we bought the 160 long, sold the 165 short call. We have the preference to be above that short call as we approach expiration. You can see we are well above. I'm going to let this one go to expiration. What that would result in is assignment of the 160 long, exercise of the 165 short, with very, very rare exceptions. So that would be a $5 profit on the stock. We subtract what we paid for the spread in the first place, and that would be our realized gain, assuming we're still above 165. I say assuming because what could happen between this moment and close of business tomorrow? Yeah, we could get, who knows, really bad news that comes out, stock crashes. Maybe it would need its worst day in the last, all the way back to here, I would suppose, all the way back to January. It's not likely, but it could happen. And sometimes I allow these trades to go to expiration just to see if we can get one of those things to happen so I can talk about it after the fact. But in this case, most likely by a pretty fair margin is that we just hit expiration in max gain. So I'm going to leave that alone. Our UNH position, okay, there it is. I said it changed its status. Notice it says in the money. It didn't say in the money just a second ago. I noted, oh, look, it's gone. What's happening there? Well, with this, we own the $300 call. Martin says, wouldn't you just close the NVIDIA? The trader certainly could, right? They could consider, as long as they're able to fill. I can't always say certainly, because there's always a chance, especially if we're dealing with illiquid options, that a trader can't get a contract closed. But right now, this contract is done just about as good as it can do. What we were hoping for when we bought this was for the spread between the two strikes to widen, the cost between the two strikes to widen to $5. Look at the difference right now. It's a $5 wide spread. There's about a $5 difference between the two. So we could put in a closing order. Yeah, so Martin, the trader, has done just about best they can do on this trade. So they very likely have motivation to close it out. Sometimes as an educator, though, I like to push my luck so it can give us something to talk about, because a trader might think, oh, heck, it's going to get there. I'm fine. And they just leave it alone, which is what I'm going to do. And then they come back, they turn their computer on, they launch Thinkorswim, and they look, and the stock collapsed on Thursday or Friday. And that $5 profit, which they thought was a lock, has evaporated. So I want to see if we can get that to happen so I can talk about it. I think that there's a learning opportunity there. I don't think it's going to happen. But yeah, trader probably would just close this out right now. Okay. All right. Anyway, so our UNH position bought the $300 call with 2 years left on it. We've sold a 360 short call. Our preference here is for the stock to go up, helping out our long call, but stay below 360. Look where it is right now. It's actually been flashing above 360 and back below and above and back below. We only have 1 day till expiration. Let's look at that. Let's see. That was our UNH trade, right? Yep. So UNH, we saw an inverted head and shoulders with an island gap reversal at the bottom here. Started to rally. We broke the neckline of this inverted head and shoulders. That neckline acted as a nice support, started the stock heading higher. And look at where we are. There's our 360 short call. There's expiration. We are dancing right on the edge there. I think what we're going to do, there's an earnings announcement over the horizon. So we could just buy this short call back. We could maybe roll it out to the 24th, the weekly contracts. Let's see how we're doing overall. All right, so we collected 665 for this short call. We might be able to exit for about half that. So about 50% of the maximum gain is where we're sitting right now. Let's do that, and let's revisit this long call after the earnings announcement. Earnings could go well for this. It could go poorly. But right now, we're going to be attempting to bank a profit here, right about half of our maximum gain. Let's create a closing order and buy that call back. Mid at 335, a natural at 345. Let's just lock in that at 345. Click confirm and send. We're attempting to buy that call back for 345 plus a commission. Let's send that order off and see if we can get that filled. And while that's working, let's see. All right, so we're willing to spend 345. The mark is only 340. So right now, maybe the trader feels like they're being pretty generous. It's still not a guarantee the order is going to fill, but we're going to let that work for a minute while we talk about ExxonMobil. So this is a long call vertical. Bought the 25s, or bought the 110s, sold the 111s. We want our stock to be above 111 as we get toward that expiration. It's still 8 days away. We're at 112. That actually is doing just fine. If we look at this one, there's our long, there's our short. We're up here in our max gain territories. Not in a really comfortable position yet. We probably prefer to be way up here. but it's still going fine. I'm going to let that one continue to work. So Chris says here, you're rolling the 360. You know what? I could, Chris, in the interest of time. Really, that's the decision here. I'm not going to roll that. So what Chris is talking about by rolling it just means close out the position that we're in, open a new one using the same order ticket. So close out the short, maybe sell one out there on the 24th, the weekly contracts that expire before the earnings on UNH. I'm not going to do that today. I'll revisit that after that earnings. Okay, but that'll do it for our current positions. We had to close out that JPM trade unprofitably, as it turns out. That's what happens. I want to take one more quick peek at JPM, see if that continues. Yeah, it's still strengthening. If this continues to strengthen, that 87 cents that we were able to pull back out of this might feel pretty good. If it collapses, that if we were to see a reversal of price for JPM down below our 300 strike, maybe we don't feel so good about that exit. But we'll let that go. Gary says oil is going down on XOM. Well, XOM relying heavily on oil prices. Still having a decent up day. Yep. But we'll see how that one plays out. But I want to talk about now, it is earnings season. And so for some traders, they'll plan trades and place them right before an earnings announcement. For others, though, they structure strategies around what appear to be historical tendencies after earnings. I want to go back. Let's have a look at the S&P 500 just to set the stage. And yet I'm going to take this information and just wipe it off. Because here's what a typical technical approach to trading in today's markets might be. We might look at the S&P 500, see what it's been doing. The S&P's been having a great run since April. It had that rough sell-off on Friday, and then we've been in recovery mode, and now we're only, how far are we below those highs? Let me click here. Let's move down to there, and we are, about 1% off all-time highs. So we have a very bullish market that seems to be continuing right up to the present day, and yet earnings are pretty much standalone events. We can look at trends, we can do technical analysis, but unfortunately, that doesn't inform us greatly about what's likely to happen on an earnings announcement. Interestingly, earnings themselves, viewed in isolation, may influence price until the next earnings announcement. I have to say may, because not every earnings announcement, not every stock is going to behave according to this premise that the PEAD strategy proposes. But we're going to be sort of ignoring what's happening with the S&P 500, not entirely, because I'm going to wind up probably putting a bullish trade on anyway, but it's not going to be because of the S&P 500. But we're trading this phenomenon known as the post-earnings announcement drift, PEAD. I think it could have just been post-earnings drift. That would work just as well. But the assumption here is that the direction that a stock takes in the week following an earnings may be the direction that it generally assumes until the next earnings announcement. Have you ever observed something similar? Have you noticed? Seems like however earnings goes, until the next one comes along and either reverses it or confirms that direction, the stock just seems to drift in that direction. Well, that's known as PEAD, also known as the Wall Street drift. So for some traders, they structure strategies around that assumption, and that's what we're going to be doing today. And I'm going to skip right to the spoiler, and let's just do it on J&J, which is a stock that just recently announced earnings. Right now, we don't have a lot of stocks to choose from, right? Because we're very early in earnings. And even for the companies that have already announced earnings, there's still a lot of post-earnings volatility that some traders who use this strategy might be trying to sidestep. But I want to outline this example strategy. Let's get rid of this discussion from a previous webcast. So this is our PEAD strategy. Right. Now, this is just an example. Not everybody trades this way. A trader should always feel that they can tailor an approach to whatever suits them if they're going to use a specific approach to trading at all. So this is a discussion of the Wall Street drift, of the PEAD strategy. It is not a promotion of this strategy, right? So, number one, here's some rules. Let's outline some rules for this. I've written them down so I don't forget anything. But first of all, this is typically done on mega caps only. This is for a very specific reason. I'll go through these fairly quickly, but the way that we're going to be structuring this spread trade, a lot of the contracts, especially on lower liquidity stocks, are going to have wide bid-ask spreads, and we want to try to narrow that as much as possible. A quick step to do that is to make sure that we're only trading on extremely large companies. So mega cap, if you're not familiar with that term, means $200 billion in market capitalization or larger. All right. Next up, number 2, is that we enter trade 2 to 5 days after earnings. Two to five. So we're getting the earnings out of the way, and we trade in the direction stock has moved since close of the day before. Cursor out of the way. Earnings. All right. So we look at where was the stock before earnings and where has it moved since. And we're just going to set up a trade in that direction. That means we are going to ignore the trend. That, for a lot of traders, I don't know why I want to keep typing why, that for a lot of traders is going to rub against the grain. Yeah. If we see a stock that has, let's say our stock has been going up nicely, which in this case actually is what's been happening with Johnson & Johnson, the stock has been going up nicely. We might think, well, let's just keep trading that direction. That's actually a pretty typical technical approach, but it's not the way that a PEAD trader structures their trade. Because the assumption is, regardless of what the trend was before the earnings, it's what's happened after the earnings that determines. Yeah, Corey says the trend is your friend. It's not the assumption of the PEAD strategy, though. It may be coincident with the trend. And for some traders, if they want to just make sure that the earnings went in the same direction of the trend to make them comfortable, is that a rule that could be added to this? Of course it is. We should feel comfortable customizing any approach to the way that we prefer to trade. Okay? But typically, with this approach, a trader isn't always hesitant to trade against the trend. It's what the earnings did, because the assumption is just of this phenomenon is that whatever the stock has done after the earnings will tend to be the general direction of the stock until the next earnings. Now, tendency is one thing, and reality can be entirely different. Prakash, you like that I'm making this out on the side? Yeah. Chris says it could it be a counter trend trade then? Absolutely. Yes. Yep. Like, for example, here, stock's going down. If the trader looked at this a week after the earnings, they notice, ooh, the stock is strengthening. Would this be consistent with the trend? Taking a bullish trade right here? No. And yet, where did the stock tend to drift? In this case, that's a strong word, drift. In this case, it kind of rocketed upward. Now, actually, before the next earnings announcement, it surrendered a good portion of that direction, and yet we were still net up. Greg says you have to retrain your brain. My apologies, Greg. Yeah, this is one of those strategies that not every strategy is built exactly the same way. And this is one of those that may depart from other technical approaches. All right, next up, buy at the money strike, sell out of the money strike. What this is going to do generally is it's going to structure a trade that's basically a 50-50 reward to risk. Maybe it might offer a little bit more reward than risk. Maybe it might offer a little bit more risk than reward. But the structuring is actually going to, it's by design, limit the downside of the trade. Usually not going to see much more risk on this trade than reward. Okay. Number 6. Let me make sure I'm not skipping anything here. Yep. Okay. Number 6 is we select the expiration the expiration month or the next earnings. For example, if we're structuring a trade right now for October, next earning is 3 months away, so that's January. So we would select the monthly expiration, not weeklies, monthly expiration in December. That's the month before the next earnings announcement. Problem with selecting that, let's say in January, is we don't know. Is the earnings going to happen before or after the third Friday of January? And selecting weeklies. Typically, when these trades are placed, there are wide spreads between the bid and the ask prices on those more distant contract expirations. So the weeklies will tend to have even worse than the traditional monthlies. All right, now, number 7. We're going to exit, if we can, at 80% the maximum gain. Let's call that the TMG, the theoretical maximum gain. Shall I spell it out? Let's just spell it out. Okay, and finally, no stop. There we go. So this is how we're going to be structuring our trade. I'm going to set one up. I'm going to explain why we're doing it the way we're doing it all along the way. And there are some of these things that for some traders is going to rub them the wrong way. What are you talking about, Cameron? No stop? Aren't we always supposed to have a stop? Absolutes are pretty rare in trading. Okay? Ignore the trend. Aren't we always supposed to always trade in the direction of the trend? Not every trader does. Not every strategy requires it. All right. So in any case, yeah, the basic assumption here is whatever the stock does in the days after the earnings, not the day after earnings, but in the days after earnings, that will tend to signal which direction the stock is likely to go. Now, not every model says this is accurate. Maybe that this tendency has diminished. Others still argue that it's still prominent. In any case, the assumption here, though, is that whatever the direction is in the days following an earnings announcement, that will tend to be the direction until the next earnings announcement. Sometimes it has a strong tendency, but then starts to reverse course. That actually is what this addresses. Okay, so I'll explain that. But in any case, let's go start to build this example trade. I'm going to go to the trade tab. We just had our earnings announcement in October. Next earnings is going to be in January. So, well, actually, let me. I'm kind of skipping ahead. First of all, let's talk about this. Mega caps only, $200 billion companies or larger. If you're not sure, a quick way to check is to just Google it. Is this company a mega cap? And if you want to throw in $200 billion just to make sure that we're getting a consistent definition of mega cap. Why do we care about mega caps? Because low liquidity stocks, even just large cap companies, will tend to have very wide spreads when we go out 2 months, and especially if we're trying to trade right after an earnings announcement. All right? So we're trying to narrow that spread as much as possible. Even on a company like Johnson & Johnson, if we go to the trade tab and we go out here, I'm skipping ahead, sorry. Let's go out here to the 19th of December. Our next earnings is going to be in January. So let's go to the 19th of December. And we look at these spreads. They're still, on a 7.30 contract, there's still about 35 cents there. There's about 30 cents here. It's a pretty wide spread. You'll see really wide spreads actually on most stocks, on the vast majority of stocks. It's a combination of factors. The distance from expiration can widen those spreads, but also the volatility that's inherent after an earnings announcement can widen those spreads. Okay. Number 2, we're going to enter this position 2 to 5 days after earnings. Here's a little bit of a rule of thumb. If the stock has had a highly volatile earnings announcement, really on the move, for some traders, they might prefer to wait 5 days rather than 2. Couple of reasons. When there's a big, strong earnings reaction, that can cause the spreads between the bid prices and the ask prices to really widen, making the contracts less liquid, making it harder to get into the trades, and just increasing the risk of the trade. Now, another thing that can happen is that when there's a strong move, very commonly there's a strong counter move, and it's harder to establish the actual direction after the earnings. So for some, they might wait a few days after those really strong moves to let that stuff settle out. Now, if there's not a particularly strong move, and on Johnson & Johnson, it's always a judgment call. There was some initial volatility, but the day-to-day change was actually fairly muted. You know, the day before earnings, we closed at 190.90. The day after earnings, we closed at 190.85. Barely a move. And now, a couple of days afterward, we're drifting higher. So we're starting to establish our direction. We're probably seeing those spreads between the bid and the ask narrow. And so therefore, which direction is the trader going to go with the structuring of their trade? Are they going to trade a bullish trade or a bearish trade? Well, we trade in the direction the stock has moved since the close of the day before earnings. So which direction? Let's zoom in. Here's where we closed. Here we are a few days later. We're going to be putting together a bullish trade. All right. Next up, we ignore the trend. It's nice that this was uptrending. In this case, that might be a confirmation of the trade that we're considering, but it would not be. I skipped, actually. No, I'm good. It's not a requirement of this approach. All right. Okay, next. Which spread do we choose? We're going to go with buying at the money and selling out of the money. With our stock trading at 192.5, our at the money strike is just the closest to the current price. That actually is going to be the 190 right here. We're going to buy the 190 call, and then we're going to sell out of the money, the 195. All right. So actually, at this point, now that decision's been made, we can just change the spread from single to vertical. And I want to talk about what this accomplishes. If we do the 190 and the 195, it looks like that's going to cost us between 230 and 295. If we split the difference, it looks like we're going to be about $2.60-ish. If it costs us $2.60 to set up a $5 wide spread, how much risk is there? Pardon me, how much reward is left? $2.60 is our risk. $5 wide spread leaves us with a $2.40 reward. As I mentioned, by setting the trade up this way, the reward and risk are going to be fairly balanced. Okay? Usually. Sometimes it's going to be slightly higher reward than risk. Other times it's going to be slightly lower reward than risk. In this case, that's kind of the scenario. Maybe $2.40 reward, maybe $2.60 risk. It really depends on how deeply in the money the trade is right from the outset. If this wasn't, this is basically, it's almost $2.50 in the money. That's why we're getting that balance. If this spread were a little bit further out of the money, we'd have a smaller risk and a larger reward. In any case, but because the reward and the risk are in balance, the trader of this strategy typically doesn't use a stop. They recognize, well, maybe I make 240, maybe I lose 260. If there's a tendency toward making the 240, let's just let this work to the fullest extent possible. I'm not going to put in a stop and interfere with those probabilities. All right, so we're going to buy out the money. We're going to sell out of the money. We're going to select the expiration month before the next earnings. That's going to be the 19th of December. But sometimes our stock does this. So let's look at this example. In this earnings, it actually was a strong move down. On a strong move, we might wait for a few days to see which direction it picks. And in this case, there was a pretty strong recovery in a bullish direction. So in this case, the trader might wind up taking a bullish trade. All right. Now look at what the stock did after that example theoretical entry. It really rocketed up. That's great. But then it did this. It came down. Well, that begs the question, wouldn't the trader very likely have had an opportunity to take some profits sometime before this strong reversal? Yep. In this strategy, if the trader's ever to get back out with at least 80% of the maximum they originally calculated they could make, so for 240, 80% of that's going to be somewhere around like at $1.90. If we can take a $1.90 profit out of this trade, maybe the trader just decides to do that. And a move like this is likely to introduce that possibility. Now, it might take all the way till expiration. It may never happen. But that's going to be the plan for this trade. Exit at 80% of the theoretical maximum gain. And other than that, we're just going to let this thing run. We're going to let it go all the way to December, see if we can at some point get that 80% gain. And if it falls flat on its face, what's the theoretical worst case outcome? 260. That's it. Okay. Chris says it's a risk-defined trade. No need to lose sleep overnight. Generally accurate. Yeah, there's always the possibility. We're dealing with short options here. Short options can be assigned at any time, and that can introduce some new risk. This is a covered position, though, so we have the long there to cover it all the way to expiration. But let's put this trade on. Right. Let's go to our trade tab. Let's go right to the strike prices that we were considering, and we're going to click on the ask price to create a buy order. Looks like this might have gotten a little, no, it looks like still about 260 to put this trade on. Let's click on that ask price. And the trader here needs to calculate how much can they afford to risk, right? If, let's say we're willing to spend up, how about we say we're willing to spend 270? I said 260, it might cost us a little bit more than that at the moment, maybe less, but let's put in 270 as the amount that we're willing to spend. Well, that would be $270 per contract that we do here. 10 contracts would be $2,700. In this webcast series, we try to keep it under $4,000 of risk exposure on a trade. This falls within those parameters. I'm going to go ahead with 10 contracts. Pardon me. Now, at the same time, though, sorry for the voice, but let's put in our order to manage the upside of the trade. So I'm going to change this from just a single order. Let's change this to first triggers sequential. So if our first order fills, it will kick in a sequential order to take profits if we're able to. So let's put in an exit order now. Once we've changed this advanced order, it allows us to put in an exit order. We can right click and create an opposite order. And we're going to we're going to sell out of this if we've made at least 80% of our maximum gain. Now, if we wind up buying for 270 on a $5 wide spread, that leaves 230 of reward potential. So let's do some quick math. 230 is the most we could theoretically make. What's 80% of that? 80% of that is $1.84. I'm going to call it $1.85. Okay. Let's say 185, just round it to a nickel. If we add that to what we spent, that would be exiting. If we're able to sell out of this vertical spread for $4.55, that would allow us to take out that $1.85 profit, and we'd be done with this trade if we can get there. So the profit management is to exit at 80%. The loss is we're just going to let it go. We're going to let it, we'll watch it all the way to expiration. There is no stop on this trade. So let's change our limit order to 455. That's the least we want to sell this for. Make that good till canceled. And this is now a complete plan. It's not the plan. This is just an example plan for trading what's known as the post-earnings announcement drift. All right, but let's click confirm and send. We're going to buy 10 of these verticals, try to get them for 270. We're going to attempt to sell those verticals for 455. If we get both of those done, there'd be $13 of commission to pay to get in, $13 commission to pay to get out. Let's send that order off. So Chris, you learned the first trigger sequential in yesterday's class. You like that? Good. Yeah. Glad you enjoyed that and that was helpful. Thanks for watching that video and thanks for being here today. But let's see how our trade is doing. Let's see what our order is. Look at this. The price has gone up on this vertical again. What's happened? Well, it's going in the right direction. The stock's going in the right direction. So it's costing more to get into this. When the stock goes up, calls become more expensive. And that's what's happening here. I don't know if we're going to be able to fill for 270. I'm not quite sure. We might have to try to nudge this up. Let's cancel and replace that order. We might have to drive that up to, let's say, 275. Let's see if we can get look at this. Yep, this is definitely moving. Even 275. I don't know about that. It's on the move. Let's go to 285. Let's click. Okay, we're trying to buy this for 285. There'd be a commission to get into this. Let's send that off. If we can get in for 285. And we get there. The drama right now. Hence, there it is. All right, we got in 275. Okay, so we are in, guys. Let's look down here. There's our J&J trade. We have our order in place to take us out. We could have adjusted that up a few pennies because we were thinking 270 is what we'd have to pay. We had to pay 275. We might not be taking quite the 80%. It's close enough. That's okay. I'm okay with that. Anyway, but guys, we've accomplished what I set out to do today. I wanted to talk through this phenomenon known as the post-earnings announcement drift and how a trader might structure a trade under the assumption of that phenomenon. Now, we're going to see what J&J decides to do from here, but we have a plan in place. Let's execute that plan. We'll follow up on it in future webcasts, so I hope that you'll join me in those future webcasts. Time for me to let you go enjoy the rest of our webcasts for the rest of the day. But before you go, let me make sure that you're aware of all the educational resources available to you from Schwab Education. Starting with, if this is your first time watching or if you haven't subscribed to our Trader Talks channel, make sure you do that right now. You can go down and click on the subscribe button. It only takes a second. It doesn't cost anything. But our Trader Talks channel on YouTube, full name Trader Talks Schwab Coaching Webcasts, this is where you can join our live streams. You can also find the playlist for previous webcasts. So if this is your first introduction to the PEAD strategy, to the Wall Street drift strategy, and you want to go back and revisit it, you'll be able to find that archive right here. You click on playlists, and then you just look for my webcast series. So this is called Trading Along Verticals and Diagonals. So it's right here toward the bottom. There's the view full playlist, and there's last week's. So great resources there. Another thing that I would strongly suggest you do is if you have an account on X, you should be following your favorite Schwab presenters there on X. That's the place to connect with us in between the live streams. So you can find Brent there at Brent Moore CS. You can find me on X at Cameron May CS. So here's my handle. And if you reply to one of my posts, I try to reply right back to you. I don't know what percentage to assign to the number of posts or replies that I reply to. I would say it is certainly over 90%, especially I've really made that an emphasis over the last couple of months at least. When you reply to one of my posts, I try to reply right back to you. So best place to connect with us is here. Time for me to let you go. Now, as a final request of you, there is a survey in the chat for our live stream attendees. So if you do me this favor, click on that survey link and then just give me some honest feedback. I'll promise this. First of all, it's a very short survey and only a couple of multiple choice questions and a comments box and a suggestion box. If you take the time to fill it out, I'll take the time to read through that data. I read through those comments. It always helps. It's never a waste of effort. All right. Okay, guys, thanks for all the thumbs up. I see 163 people watching the live stream right now. 65 have already clicked the like button. That's very much appreciated. gives my webcasts a nice boost in the YouTube algorithm, and it's a pat on the back to your presenter for their efforts. Thanks. Definitely appreciate it, everybody. But go enjoy our other webcasts. I'll see you in a future webcast or in a future video. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.